Hey guys, my name is Tom Chan and welcome to the Macro Maverick. So in this video I want to talk about a trade idea of mine that I've been thinking about for a while, and it is long gold against the Hong Kong dollar. So it's got two components to this trade. One is being long gold and the other is being short the Hong Kong dollar. So first of all, I'm going to talk about being long gold. The reason why I want to be long gold is I think we are at the latter stage of the business cycle or the long-term debt cycle. Either way you want to look at it, I think we're quite deep into this bull market, and I think there's potential for a bear market or at least some sort of market turbulence to begin to form. I think gold will be a good hedge for that, and that is why I want to be long gold. Now, in terms of being short the Hong Kong dollar, there's a couple reasons there. First of all, I think that the Hong Kong economy is probably not going as well as some people might like to think. So here I've got a chart of the Hang Seng index against the S&P 500. So you can see that this chart has kind of been going down ever since 2009, ever since after the GFC really. Now, when this chart is going down, it indicates that the Hang Seng index is underperforming the S&P 500. Now, if we use these two stock indices as indicators of the Hong Kong economy's strength and the US economy's strength, then I do believe this is indicating that the Hong Kong economy is underperforming and has been underperforming for quite some time. Now, this is sure to put a bit of pressure on the Hong Kong currency. The whole idea, I suppose, behind that then is that if the Hong Kong economy is doing poorly, then the currency will depreciate. Now, why did I talk about it in terms of the Hang Seng index, which is the Hong Kong stock index, versus the US stock index, which is the S&P 500? Well, that's because currently the two currencies are actually pegged. So the Hong Kong dollar is actually trying to follow the movements of the US dollar, such that the price, I can just get this to show up on the screen. Essentially, the Hong Kong dollar is being managed by the Hong Kong Monetary Authority, such that it stays within a band, and you can kind of see this band by looking at this chart. This is the US dollar versus the Hong Kong dollar. You can see that the Hong Kong dollar hasn't actually really moved below 7.75 Hong Kong dollars to 1 US dollar here. Let me just pull up a line, horizontal line, show you that a bit easier. It hasn't really moved below this 7.75 since really 2005, and also it hasn't really moved past 7.85 Hong Kong dollars to the US dollar. So really that shows a movement or a fluctuation of around 1 to 2% if you want to count 2000 all the way back to 2002. So this is actually a the HKMA actually has legal obligations to keep the Hong Kong dollar within this kind of a band. So the reason why I want to be long gold against the Hong Kong dollar rather than the US dollar, despite the fact that they're both, actually, well, the Hong Kong dollar is actually pegged to the US dollar, is First of all, I think the Hong Kong economy is underperforming the US economy by quite a bit, and it kind of makes me wonder if the Hong Kong Monetary Authority can actually continue to hold this peg, especially if things like the trade war between US and China escalates. So that's the first reason, being the weakness of the Hong Kong economy relative to the US economy, and also the potential for fallout from the trade war. I'd also like to point out that going long gold against the Hong Kong dollar actually results in a lower carrying cost, because the HIBOR, Hong Kong Interbank overnight rate, is actually less than the US overnight rate, which means you actually have to pay less interest if you are long gold against the Hong Kong dollar versus long gold against the US dollar. So really, essentially what I'm doing is, if they do maintain the peg, I'm essentially long gold against the US dollar, except for I'm paying less for the carrying costs of the trade. And if they do break the peg, then there's extra upside to be had. So for me, how I would like to execute this trade, it's probably more of a longer time frame trade. So I'd want to have my stop loss at probably a little bit wider. So let me just draw that. Okay, not letting me delete it. Yep. Okay, there we go. So let me just get a horizontal line out to show where I would be thinking of putting my stop loss. Well, I think because it is a longer term time frame trade, I would say here, maybe here's a good stop loss under these two kind of price points where the prices bounce back up. I'm gonna go add a little bit more risk of getting stopped out and probably put it around here. It really hasn't been this low since before 2019. So that's where I'd probably put my stop loss, where really I'd be risking about let's say 550 or so Hong Kong dollars per ounce of gold. In terms of where I think the upside lies, if the Hong Kong Monetary Authority does break the peg, or if there is truly some market turbulence, I wouldn't be surprised if we see gold back at its 2012-2011 highs. So that's potentially a return of 3,400 Hong Kong dollars. So the kind of return on risk that you can potentially see from this trade is about, let's say, 6 to 1. I think that's a fairly good risk reward. Not to mention there is going to be carrying costs, so you probably will see about 3% a year in terms of carrying costs, being long gold against the Hong Kong dollar. So that's one thing to consider. And in terms of what this trade actually does for my overall portfolio, which right now is just purely in cash because I've started this video log of my trading by essentially starting with just all cash in my portfolio. So this is actually the first trade idea I've considered for my portfolio. So I have plenty of leeway to put some risk on, and this is actually what I would perceive as a risk off trade. In terms of the technicals, you can see that there's an uptrend forming. So that uptrend's kind of formed since late 2015, and really that's always a good thing to be long something that's trending in your favor. So kind of say that's the trend. It's a bit subjective where you want to draw the trend line, but you can see that it's forming somewhat of a breakout pattern. The whole ascending triangle thing, eh? So the technicals are decent over a long-term time frame. The risk reward is good, as we've seen. Fundamentally, it acts as a hedge, as a risk off trade, and also a potential play on the trade war or the Hong Kong economy underperforming the US economy. So there's a bit of an extra bonus play that we've got. In terms of the chances of success, well, I wouldn't say that it's a big chance that the Hong Kong dollar is gonna have its peg broken against the US dollar. So to really see this trade get up to its highs in 2012, I would probably say it's only something like a 20-30% chance. But in terms of it, I mean, not in terms of it losing money, I would also think that it's only something like a 20-30% chance that we're probably likely to see it either meander within this kind of a band here and not really lose too much money, maybe let's say 50% of the risk we put on this trade, or we could really see it break out. So really the three scenarios I'd be considering is around a, let's say, 25% chance that it gets back up to here, giving us a 6-to-1 return on risk, maybe a 20-30% chance, or maybe even a 40-60% chance of it just kind of being within, ending up in these two, between these two kind of price points here and here. And then there's probably about a 20-30% chance that it's just going to hit our stop loss. So overall, I think I do like the overall expected return on this trade. So I think it's something that's worth considering. If the price does move up, I think I'll definitely be able to leg in and ride that trend upwards. If it does move down, then I can always exit early if I feel uncomfortable, or just let the stop loss do its job. So that's really the long gold against the Hong Kong dollar trade idea. And well, if there's an opportunity to enter it, I'll let you guys know. Okay, well, thanks for joining me, and see you guys later.